Very good evening, one and all present here. Welcome to today's Investor Awareness Program. After a gap of 2 years, this Investor Awareness Program is being conducted by SIRC. We have with us Sri V. Nagappan sir, who will take us through investment and risk management in volatile times. Before we move on, let us all raise for ICAI motto song as a mark of respect to our Mother Institute.
Yeshasuteshu jagrati Yeshasuteshu jagrati Kamam 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 Purushalo nirvimana nirvimana Adeva shukram Brahma Adeva mridamuchyate Asmin lokah shataha Sarve tanuna charye kashchana yadi kashchan Etat dvaita etat dvaita etat dvaita etat dvaita etat dvaita etat dvaita
Thank you. Please be seated. It's my privilege to introduce Nagappan sir. Sri V. Nagappan, distinguished and renowned stockbroker and investment expert, is a master degree holder in business administration from Annamalai University in the year 1987 with a gold medal. He served SIRC papers and boards as a management trainee. He then joined the Chemplast Sanmar group and was in charge of the sales of PVC resins for all of Tamil Nadu. Bitten by the entrepreneurial bug, he launched a company to make granite monuments and markers, a 100% export-oriented unit. He quit this in 1994 and turned full-time into stockbroking, an arena he joined 2 years earlier. He is today the chief mentor and advisor to MSC Financial Services Limited, a subsidiary of the erstwhile Madras Stock Exchange. It's a member of the institutions such as NSE, BSE, CDSLDP, and MCX. He trades and invests in equity shares, debts, instruments like bonds and debentures, and foreign exchange. Mr. Nagappan has held numerous prestigious offices in corporate life. To mention just a few, he has been a director of Tamil Nadu Newsprints Limited, Tamil Nadu Power Finance and Infrastructure Development Corporation Limited, and Tamil Nadu Industrial Development Corporation Limited. He was a member of high-level committee formed by the Tamil Nadu government to frame policies and guidelines for the disinvestment and shareholdings by the state public sector units. He was the chairman of Hindustan Chamber of Commerce, expert committee on economic affairs, insurance and banking. He was the director of the Madras Stock Exchange Limited for several years and chairman of the Federation of Indian Stock Exchanges in 2008. He is presently a member of Board of Studies of Madras University's Commerce Department, also the Economics Department of Kalasalingam University and B.G. Vaishnav College. An articulate and lucid communicator, Mr. Nagappan has been a columnist for financial dailies and business magazines on capital market regulations, personal finance, mutual funds, insurance, tax planning, commodities, currency futures, and other subjects. He has published 6 book compilations of his articles. He is on the visiting faculty of IIM Trichy and Chennai and other institutions on capital market regulations and personal finance. He is a member of numerous business and trade bodies such as Hindustan Chamber of Commerce, Indo-American Chamber of Commerce, Andhra Chamber of Commerce, Madras Management Association, Tamil Nadu Investors Association, etc. With this brief, I present before you Sri V. Nagappan. Over to you, sir.
Good evening, friends. I see quite a lot of youngsters probably have not invested in the market or already invested in cryptos. How many of you have invested in cryptos? Stocks? Mutual funds? Okay, nice to see so many of you have invested in stocks and not in cryptos. Or probably last year, had I asked the same question, I think many of you would have raised your hands, in crypto. What is your experience in investing in cryptos? Bitter experience. About stocks? Same bitter experience. No, better experience. Oh, bittersweet. Bittersweet probably because of experience. Maybe the rate at which the markets have fallen is not very big, in India at least. The rate at which markets have fallen or the tech stocks have fallen. By the way, how many of you invested in US stocks? Anyone? Okay. Thank God, you're not invested in US stocks. The Facebook stock last year during the peak, it was trading at $380 or something, $350 plus. Meta, the parent company of Facebook. You know the rate right now? The results came out yesterday, table yesterday. It's trading around $156. From $380, it has come down to $156. Thank God our Infosys or TCS or Organised has not fallen that much. Organised is not listed in India, but still it has not fallen that much. But cryptos have fallen much worse. I think more than 50% in case of Bitcoin. But Ethereum and other, I think Dogecoin had all fallen much more than that. I think almost vanished Dogecoin. I think this happens when a new product is introduced in the market and the regulatory risks are there and people don't understand the concept. Many people who come into the market to trade in such, such securities or such investments are people who try to take advantage of the opaqueness or the lack of transparency or lack of regulation. So most of them come because it is not transparent, because it is not regulated. It happened to commodities market in early 2000 or late 90s when it was not regulated properly. Many people went into commodities from equity. Equity is a highly regulated market. Particularly in India, the market is over-regulated, I would say, to the extent that companies like Organised don't even want to get themselves listed in India. They are listed in US. Many such companies want to list somewhere else, not in India, because we are over-regulated on many things. Rightfully so. I don't regret with such kind of regulation, though it is very choking for some of the companies. So the market was trading at 30 plus P last year, 35, I think, if I'm right. The peak was 35. Where are we now? In terms of valuation, in terms of price to earning ratio, maybe about 20. And is it a good time to buy? Is it a good time to sell? How do we identify whether it is a good time to sell or good time to buy? If it is as simple as that, all of us can become rich, right? It's so easy. Many people ask me, maybe it's a wrong forum to talk about that, but then, I'll take the risk of talking about it. Many people ask me these questions: what is one, single thing to make money in the market? And then most of us think that it is very important to understand the balance sheet, understand the annual report, understand the P&L account, and understand the schedules and the notes to the accounts. And if you analyze all the things properly, then you can come to a conclusion that you can whether to buy the stock or not. If that is the case, all of us chartered accountants should be very rich, right? Right or wrong? But what most chartered accountants are doing, they are writing on mail. They are doing the audit work or consulting work for somebody who is much, much richer than. So there is something else, something more than that, just numbers, just account. I'm not saying that it is not needed, it is needed. That's a foundation. But then, what is much more than that? Is it technical analysis? Maybe to decide the entry and exit point. To choose a stock, I use fundamental analysis. But to decide the entry exit point, I use technical analysis. When I say technical analysis, I don't go very deep into it, like talking about Bollinger Band or stochastics and all. To some extent, I look at support resistance and then do my level. then there is something more important than these two. The third element, three key important elements in investing if you want to be reasonably successful is understanding the numbers, understanding technicals or the timing the market to some extent. If you're going to be a stock trader, if you're going to be a mutual fund or systematic investment investor, there's no need to worry about that. You can choose some quality top 10 stocks and then keep investing in those stocks on a SIP basis. So you need, the third element is very important, is behavioral finance. How people behave in different circumstances, how people behave in different situations. And this becomes more important because of the 4 crore new investors who have come into the market now. The Depositories Act in India was passed in the year 1996. First 5 years, nothing happened, nothing much really happened. Somewhere around 2000, and SEBI made it mandatory that the listed stocks should be traded only in demat form. Then in the next 20 years, from 2000 to 2020, we had 4 crore demat accounts. But between 2020 March and now, the total number of demat accounts has crossed 8 crores. It took 20 years to get the first 4 crore demat account, but it took only 2 years to get the next 4 crore account. It has doubled in a matter of 2 years. How this happened? Various reasons. The reason number one, COVID, because of which many people started work from home. When you work from home, you have lot more flexibility. You can use 2 systems. Even if you have a firewall, you can use another system to trade, which you could not have done it in the office. You had a lot of time during market hours. You can do not concentrate on the market. Then post market, you can do your office work. That flexibility came in, and a lot of youngsters came into the market. Most of these people who came into the market in these 2 years is between 25 to 35. And people started earning more, contrary to the belief that the COVID will bring down the salary levels. It went up for a certain set of people, IT sector or technology sector. The salary levels went up substantially, by 50% almost in certain cases. So they had surplus money. Now, what will they do in lockdown when they cannot go for a weekend outing, or when they are barred from drinking a coffee, which is 120 rupees? You cannot. What will you do with that money, that kind of money? You have a lot of savings. So that has to be invested somewhere. Now, the next option, when you look at investment, you look at the bank deposit. It's so boring, 5%. Inflation is 6% or 7%. What will you do? So then the next option came in, equity. Equity was really exciting at that point of time because it was going on and on, up and up after the March 23rd fall. And the new generation of people who have come into the market has never seen failure under the first, unlike the first 4 crores. The first 4 crores have even seen failures, a Y2K failure, fall in the market, 2008 fall in the market, subprime crisis. Again, 2013 there was a fall, 2016 demonetization. The new set of 4 crores, they've not seen anything like this. They've only seen positive side of the market. So they became very bullish on the market, and they were driving the market instead of FIs driving the market. FIs also drove the market, but then it was a giant, win-win situation for all. And then when more money and more liquidity is there, it will start looking out for all types of asset classes, all types of liquid asset classes. It stopped going into real estate. It started getting into stocks. It started getting into next cryptocurrency, because cryptocurrency became very fashionable. In all my tweets or whenever I say that, careful with cryptocurrency, I used to get blasted. People brand you that you're an old man, and this is something very fashionable to say that I've invested in crypto. If I say I don't invest in crypto, I'm outdated. And but the reason I said I requested not to invest in crypto is because not that I hate cryptos. It is not regulated. When something is not regulated, don't go for it, because we have enough problem in regulated markets itself. There are enough problem in stock exchanges, stock markets. What is it now? You forget about stock markets or stock brokers. Stock exchanges have a problem today. Governance issues, right? It will make an interesting crime thriller when you read all those things. We never thought, when we were running a regional stock exchange, Madras stock exchange is something very supreme. It's like a god. It can never do mistake. Corporate governance levels will be very, very high. And So, what should one do in such a situation? The money started getting into crypto, money started getting into other asset classes. And this is what happened in 2007. People started investing in certain products which they've never realized, like structured products. That also started happening at this point of time. Thankfully, the US market started coming down and the interest rate started going up, inflation started going up. I think we've not gone to a situation where it was a bubble. Even at 60,000 Sensex, Indian market was not in a bubble. It was overvalued certainly, but not in a bubble. It was not in a bubble zone. It was certainly overvalued. So market started correcting. Now we are in a situation how to handle this. If time permits, we'll discuss some of this. Otherwise, we can move forward. So how to handle this situation? I can tell you the solution right in front instead of going through the 30-40 slides. The only way to handle this kind of volatile situation is two things. One is having a proper asset allocation, and in that asset allocation, you have a proper diversification, because asset allocation and diversification are different. It's not one and the same. You invest into different asset classes. If you have 100 rupees, you would invest into different asset classes. Within each asset class, you diversify into 2, 3 or more than that, different assets. That's a diversification. So that's one way. The second is when you are in such an uncertain time, the second key is that to go for systematic investment. Next 10 to 12 months or whatever period, the market is going to be extremely volatile. It's the only way to mitigate risk. Now you heard about this Foundation for Financial Freedom, which we handle. The aim is to, like I mentioned, that financially responsible citizens. This thought process came to us a few years back when we started noticing the companies have started paying youngsters more. The salary what normally, from my generation will be getting it by retirement. The people are getting it when they join the job. So what will they do? Of course, inflation is there. But what will they do with the money? When I joined the company, like Emplasty was mentioning, I think prior to that stage, about a week or so, I was sent to the factory. There was an orientation program where they told me that what is the raw material used and how the paper is manufactured and how it is distributed to the distribution network. And I was sent to the marketing department, I was sent to the sales department and various departments. Every one day I will be there and I will be learning from someone. I will go to the factory. So this was the orientation program. But when my son joined one of the big four, the first 2 days, one of the 2 days, that somebody came and said that why you should open a bank account with me. Some foreign bank and one Indian bank, they came, and there were 2 insurance companies came, why you should insure yourself. And what kind of insurance product they are selling, they know that these guys are going to get paid very well. So now how to take that money, deposit in the account and take that money on the other side. And the kind of the insurance product what they marketed are totally useless. It will either give you adequate coverage or give you adequate return. Returns will be low. You ask them, they will say that you have a coverage. When you say the coverage is low, they will say it gives a return. When you say coverage is low, return is low, they will say it gives you a tax plan. All are inadequate. You can get a very good tax planning with ELSS or PPF. You can get a very good coverage with a term plan with just 30 rupees a day or 50 rupees a day. You can get 1 crore worth of coverage. And you can get a better return, even an RBI bond at 7.15%. Why go to stock market? But these guys will give 5% return or something like that, and they will tell you that they're giving a return. But this is kind of the orientation. I was asking him first day that what is it they taught you? This is the orientation program or whatever it is they do sometimes. Basically because they give on one hand and then try to take them on the other hand. Now how to prevent this? Because this was the situation, exactly the situation US was in 1970s. If any one of you have read Conspiracy of the Richest, try to read the book. It's by Rich Dad Poor Dad, what is the name? Robert Kiyosaki. Okay, he's written the book Conspiracy of the Richest. He says that until the 1970s, US had a lot of syllabus or teaching. They used to teach the students and children about the importance of saving, importance of building wealth, creating wealth, and for the long term, and all those things. Somewhere they removed it because the US political system wanted a weakened society which can be easily manipulated. So they said that enjoy now, pay later. That culture, credit card culture came into that, and you know where US is today. One of the biggest. The US is a peculiar situation. The government is the largest borrower, the public also largest, but they borrow. At least here we save, public save, government is borrowing. That's a different situation in India. Anyway, so we thought that we should not be moving towards that culture, and we should slowly build into inculcate the savings habit and the habit of investment and financial literacy. Basically, it is financial literacy for. So we take classes. We conduct 1.5 hours, 2 hour session, which is SEBI material. The content provided by SEBI. We take it to NGOs, self-help groups, women self-help groups in and around Madurai. Because of our bandwidth, we are not able to reach. Bandwidth means not monetary. Monetary issues are not there. There are enough money we have, and there are people who are. But the people who can go and handle the session, only 2 or 3 people available in Pondicherry and Madurai. We take classes to government schools, teachers, and all. So why I'm saying this is that if any one of you is willing to volunteer, you can think about this. The content is available in SEBI's website. You can take it to 6 different classes of people: school children, college students, then housewives, working person, and businessmen, retired people. So these are the 6 categories. So how to construct a portfolio? That's something very important. I think you all have SAPM. Must have read in SAPM about that. So constructing a portfolio is very, very important, and the way you construct is important, and that will help you to write bad as well as good time in a proper manner. So how to do that? The first is capital allocation. You diversify between riskless and risky asset class. Then you diversify among asset classes and markets, and then finally you diversify among each asset class, within each asset class. Now, this is one way of doing it. You have precious metals, stocks, bonds, cash, and real estate. And the difference between this, asset allocation is cash, commodity, bonds, and stocks. Diversification is within equity. You have large cap, emerging markets or international markets, small cap or mid cap. You can invest in, like I said, today great value is available in India itself, so there is no need to look at US market. But then US market also is very interesting right now. If you look at most of the stocks which are trading at very high multiples, are trading at 50% discount right now. Even stocks like Amazon has come down, Google, Alphabet has come down. Post split it is trading at $110, I think. So you should look at that. It's a process of learning also. Now we have to understand the risks. What kind of risk leads to volatility in specific stocks or the overall market in the country or global markets. So there are various risks. So the global risk is or country risk. The good example is the recent war in Russia, which we thought that it is may not be beneficial to India, but it turned out that it is beneficial to India because of crude. We are able to get crude at a lower price now. Then not only that, we are able to buy crude in Indian rupee. So both benefits have come to India now. But sometimes, the most risky thing, what we think, it's a perception. We think it's the most risky thing. Like, for example, many people think stock markets are risky. But for me or my father, putting our money into fixed deposit, I don't have even 1 rupee into fixed deposit. That's the most riskiest thing I would do. But I will not suggest you to do that. Don't do that. It will depend from individual to individual based on your risk appetite and how you manage, how much of time you can spend on managing your portfolio. So the risk is a perception. It varies from people to people. So in Russia, that war has clearly indicated that what could have been a drawback for us has become an advantage for us. Similarly, about 20 years back, many of you may not be aware of this. Suddenly, one fine morning, until then, smoking in public places was allowed. My friends, many of us, I was working when I was in Templas, I was working in, there's a building called Dunn Building in Mount Road. So there was a Chennai branch office. Post lunch, we used to come down and they'll go and buy cigarette and smoke and then come back. So smoking was allowed in public places. It was not banned. 2001 or 2, I think, Kerala High Court banned it. Smoking in public places was banned. Immediately the stock crashed. Because people expected that slowly it will be banned in all other courts also. So in all other states also. And it happened. It happened in all other states also. Now smoking in public is banned. People thought that it will bring down the stock, the turnover and the stock price will come down. It happened for a short period. But cleverly, the company did something very interesting. They got into something totally unrelated diversification. In no way they are connected. They had hotels always. Hotels was there always. Paper was there always. But then they got into FMCG, which was under it. They've been supplying packing material to FMCG companies. So they started making biscuits and other things. That mitigated the risk, which are, the legal risk, what happened because of that. To some extent today, close to 50% of the turnover or even slightly more is FMCG, depending upon quarter to quarter. They're no more only cigarette company. Non-cigarette turnover is more than 50%. There could be a sector-specific risk which you have to look at. For example, sugar. If the cultivation is not good, then the production will come down. And contrary to this thing, the sugar price will go because of the short supply. So these are all metals. Last year we had a good rally, but this year it is banned. So sector-specific risks are there. Suddenly, if ATF price goes up in international market or food price goes up, airlines will be the most affected one because they operate at thin margin. They cannot survive. And they are always, most of the airlines world over are in bad shape, always, continuously. I don't know how they run. So this is one risk. There are company-specific risks. If there is, Tata's, it happened sometime back, and it could be Infosys when Narayana Murthy stepped down, and then all of them, one by one, the promoters stepped down. There was a risk attached to that. After them, what will happen? After this CEO, what will happen? That kind of issue could always be there. Recently, it happened in the rating agency where the CEO resigned and the stock price tumbled. Okay. Then there are interest rate risk. There is a currency risk, devaluation risk. It happened in Bharti Tele because a few years back they have invested a lot in Nigerian market, and Nigeria devalued their currency, which affected them a lot. So these kind of risks are there. Even shale gas, until 2008 or 9 or 10, until US started, specializing in the technology of making crude or oil out of shale gas. They squeeze the sand and they extract crude. That technology came into place. Until then, US was net importer of crude. Now, suddenly things changed from 2012-13 onwards. They become neutral, and then they started exporting. This changed the entire dynamic. The ship which goes into US with crude, they used to come back most of the time empty. Now the ship goes empty to US, and then they come back with crude oil ships. So the logistics also, everything changes. These kind of risks are always there. That brought down the crude price, and the OPEC countries lost the bargaining capacity in case of crude because of this US crude shale gas. Okay, there are various other risks, like, though we spoke about various geographical risk and all, there is broadly you can classify them as systemic and systematic risk. And within systematic, it is unsystematic risk, which is not systematic. So these are various risks. This systematic risk is, in a way, it is undiversifiable risk. You cannot resolve this or mitigate. You can mitigate the risk, but you cannot completely avoid it. You can mitigate it by going short or long. You can hedge it in the sense that you cannot mitigate it, but you can hedge it, right, with the futures market. It cannot be done through diversification. So unsystematic risk can be mitigated through diversification. If you are you've invested into companies which export, and you have invested into companies which import. So if the dollar price goes up, the risk is mitigated. If one company benefits, the other company. If you have invested into IT companies, when the dollar comes up from 73 to 80, the IT companies are the most benefited one, or any export-oriented companies are the most benefited one, while the companies rely on imported raw material are the most affected one. When the dollar depreciates or rupee appreciates, which is very rare occasion, which happened in 2008 or 9, I think it came down to 38 from 45 or something. So when something like that happens, the countries which import, the companies which import will be benefited and the export will be affected. This happens. But unfortunately, in India, what happens is whenever the dollar appreciates, the exporters are supposed to benefit, right? But what happens is that the buyers know the weakness of Indian vendors, and they squeeze them. The moment dollar becomes 75 to 80, they reduce the rate. So unfortunately, we have to put up with that nonsense, except very few exporters who have the bargaining capacity. Most of them have to fall in line. then systemic risk is something which, it is at a company level. Suppose if it happens, it can affect the entire, it has a ripple effect. In other words, it has got a ripple effect. In US 2008, this happened, too big to fail happened, AIG and those Fannie Mae, couple of companies which got affected, and the entire economy, it affected the entire set of companies which are connected with them. I don't want this to happen, but suppose, okay, let's not discuss about this. Let's discuss about something which happened recently, ILFS. ILFS, to some extent, it is not a perfect example, but to some extent, it is something like that, too big to fail, because they're too interconnected. If you look at what are all the companies they are connected with many companies in Tamil Nadu, many companies in every state. They will go and do consulting, and they will take 10% stake in that company for that as a fee for the consulting. And without investing, they will get a stake in that company. And a lot of other things happened, which probably one day will come out as a book. I don't want to say that because it's getting recorded, but one day we will see what really happened in ILFS as like what is happening in some of the stock exchanges. So too big to fail is something like that. When it happens in one company, it affects the entire chain, and it has got a ripple effect. This is what exactly happened in US. It's a cascading failure. This is what happened in US 2008. What happened? There was a lot of money in the market due to Greenspan, Fed chairman, in early 2000s, he started printing a lot of American dollar. So a lot of American dollar was available in the market, which meant a lot of liquidity. When people have a lot of money, the government's thought process is that this money will go into productive purposes. This will start, it will go to manufacturing, it will go into employment generation. This is the plan of government. That's why they generate this kind of liquidity. But instead of that, what happened is typical of any BFSI companies, most of the funds or all those people, they thought of making money in the short run, and they started investing first in stocks, then in currency, then in crude. So normally when one asset class goes up, other asset class will come down. If you notice in history, when markets goes up, people will sell gold, people will take out money from fixed deposit and invest in stocks so that they benefit out of that return. When the market crashed, they will try to take out the money and put it into safer haven like US dollar or fixed deposits or gold. But 2002 or 3 to 2008 was the only period in the last 30 or 40 years where all the asset classes went up. Gold price went up from $285 to $1,850, $1,150, no, $1,800. Okay. From that, it crashed to $1,100 later. So $285 or $300 to $1,800 from 2003 to 2012. Stocks went up. In Sensex was about 3,000 or 3,500 in 2001-2. From there, it went up to I don't remember, 21,000 in 2007-8. It went up to 21,000. And if you look at the real estate prices, went up. If you look at interest rates, also went up to 2005-6, and then from 5-6 onwards, it started coming down to 5%. We are talking about 5% today. It was 5% and 6% in 2006-7 itself. Because people started taking money from the fixed deposit and started investing in the market. That's one indication when interest rates are low and markets are up, you should get out of the market. And that is the only period where all the asset classes went up because this excess liquidity chased. And every other government followed the same footsteps of US and they started printing money. They have to, otherwise they'll be in trouble. So the money went into that. Crude oil price went up to $150 or $140 in 2008. And from there it came down to $30 and then it went up to 100 plus now recently. And then last year, I think now the year before and last year, during COVID, it came down to 30 or below 30. Now it's again 100 plus. So such kind of volatility happens because of excess liquidity. And due to that excess liquidity coming to this slide, in US, most of the housing finance companies started marketing aggressively the housing loan. To an extent that they told the people who don't even need the house or don't even need the house, means they already have a house. So they told them that you buy another house, it is a good investment because the house prices are going up because of the excess liquidity in the market. People started buying more houses. And they didn't realize that the house prices were going up because of the excess liquidity they are using to buy the houses. They are buying and though the market is going up. So house prices started going up. More and more people started buying houses for investment. They thought that they can repay. The next level, what this company did was that you cannot repay for next 1 year. We will give you 1 year holiday. You start repaying from the second year. So people who cannot repay also started buying houses. They thought that 1 year later they can sell the house and make some money. But 1 or 2 years later, what happened? The housing prices stagnated at certain level. They didn't go up. Meanwhile, these people are not able to pay the EMI for the second house. So they used to put it in a cover, put the house key in the cover and send it to them. It's called jingle mail or something like that. Funny name. So they used to send it to them, and then they used to get out of the house. And then people at one house also got out of the house and they stayed in a tent. Market economy collapsed. And why it collapsed? I mean, it's aggravated by once the housing prices started coming down, people started selling the house. They're not able to sell the house because no buyers. Everybody had 2 houses or at least 1 house, so they're not able to sell the houses. So this, meanwhile, the companies which lent money to these house owners, they packaged them into asset classes, bonds or derivatives, and sold it to investment companies, investment bankers, saying that these are all A-rated, these are all B-rated, second, they sold it to them. The companies which bought them as a bonds, because it's like a repledge what we do in India, but it's in different format that they did it, and they bought it as a bond. They sold it to investors, high net worth investors, retail investors. And they used to ask a question that if this fails, if the house owner doesn't pay, what will happen? You will also not get your bond paid. So what will you do? So the company which sold, the housing finance company sold the bond to the investment company or the investment banker sold it to the investor. He said, I will insure this. And they all insured it with the AIG. Now, once the collapse started happening, all the housing finance companies went into problem. Then the bonds started, the default started, collateralized debt obligations or CDOs, they used to call it, and mortgage-backed securities. The bonds which are sold are called mortgage-backed securities. Those securities default started happening. Then the investors came and asked for money, so they have to go to AIG. AIG collapsed. So government of America has to interfere in it, and they came out with the TARP, T-A-R-P, I think, reconstruction program, something, I've got the expansion of it. That's what happened. And the funniest thing is that with 1 rupee, they created 4 investment products. It is the same one lending. They lend to me. The business ends there. In India, if a banker lends money to me, there it ends there. Now, this loan is again sold to someone as a bond. That bond is sold to the retail investor. Then one insurance company makes money out of it. So this is the kind of the thing they did. Why they did all these things? Because the incentives bonus is based on business expansion, the CEO's incentives and bonus. So they had a vested interest. They went on blindly doing this. After 2-3 years, they get their money and they will resign and go to another company. Now there are a lot of thought process going on that we should restrict the CEO's salary. We should restrict so many multiples from the bottommost to the top, and other things are happening. And staggered payment to the CEO. Most of the companies follow a pattern where they declare a bonus, let's say about 50 crores, but it will be paid in 5-year term, 10 crores, 10 crores, 10 crores. So he has to stay with the company, and you should not do anything. But so broadly, this is the systematic risk and unsystematic risk. Systematic is like interest rate risk or market risk or purchasing power or inflationary risk, and unsystematic is business risk specific to the company's financial risk, credit risk, operational risk for the company. I'll skip this. Now, as I mentioned, it does not mean that too much of diversification will help you to completely eliminate risk. It will help you to reduce the risk levels. It can reduce the unsystematic risk. As you diversify more and more, it will reduce the unsystematic risk, and to an extent that you can bring it down to almost zero. But systematic risk will remain. That will be possible only that is possible only by hedging. You can do that to some extent. Now, when you look at all this risk and all, as I said, diversification and asset allocation and hedging to some extent can help you. Hedging is not possible for small investor. For a retail investor, it's very difficult to hedge your risk. But diversification is something which we can do. The only hedging tool indirectly probably could be the SIP. What we use it for we call it a systematic investment. The other thing which in volatile times, how to identify the volatility, the cycles, market cycles. Howard Marks has written a book on market cycles. It was published only 2-3 years back. It's a very interesting book. You should read. There are hardly few people write finance, economics, or behavioral finance or behavioral economics in simple terms. Like it may be very basic for chartered accountants or CA students. But somebody who is non-finance, there is an interesting book called Romancing the Balance Sheet. You have seen it? What about it? Anil Lamba, I think, the more than it. Romancing the Balance Sheet. That's a very interesting book with interesting layout and explaining, how to look at a balance sheet or a annual report, not annual report, balance sheet, and with interesting layout. So this book is also one such book, Market Cycles by Howard Marks, is an interesting book, presented in a nice manner. Another book is Charlie Munger's book. That's not about market cycles, but that's more on markets and related to life and various other things. So one such thing is, quantitative wave. It's a Russian economist who spoke about longer market cycle, which prolongs from 40 to 60 years. Many people say that this 40 to 60 years now reduced to 15 to 20 or 20 to 30. Okay, so what does it mean? Till now, in the recorded history, they say that there are 5 major cycles which has happened in the recent past, maybe about 250, 300 years. The first cycle resulted, when the invention of steam engine happened, from 1780 to 1830, it ran about 50 years. The second cycle, because of steel industry and railroads from 1830 to 1880. The third one, 1880 to 1930, because of electrification and innovation in chemical industry. And the fourth one between 1930 to 1970 by autos and petrochemicals. And then the fifth one, which is right now we are going through 1970 to 2020, probably is on information technology. And the sixth one, there are differing opinions. One such opinion is biotechnology and healthcare, where people may live longer than 150 years or 180 years. The one is IoT. We can keep discussing. We don't know which will be create the sixth wave. And every cycle is classified into 4 different phases or sub-cycles. The spring is something which happens when there is increase in productivity happens, and because of that, more people will be employed, more salaries will be given, more spending will happen, so inflation will happen, and interest rates will go up, and it will signify the economic boom. And then the second phase is summer. After some time, there will be affluence level goes up, and the people's attitude towards work will change, and that will lead to slowdown of economy. The classical example could be, you ask any one of your friend or cousin who settled in US, the working style of a typical Indian settled in America and the American citizen, how both of them work. If someone calls you on a Saturday and asks you to do some work, will you do or not? Sunday, will you do or not? Will do. That's our nature. But once affluence level goes up, will we do it? Most of us may not do it. Weekend, I'm busy, I will not do it. I remember, I think when he read about my granite, I did some business. I remember we invited a buyer from UK and he came on a Friday morning. I took him to the factory, and next day I'm supposed to take him to my quarry. So Saturday morning, Friday evening, when I dropped him in the hotel, I asked him, can I come and pick you up tomorrow? He said, no, come on Monday. 2 days he was not available weekend. Even when he was in India, I had to spend more money on making him for his accommodation. So when affluence level goes up, people will, the productive level generally comes down. And this is what is happening in many developed nations. And countries like India or developing nations are improving because of this attitude. We don't have this attitude. The third level is autumn. In fact, when I speak about productivity, one of my young friend like you, I was commenting upon something, one of the big 4, is that the global rating on HR or certain things is very low because of their Indian branch, how they make them work, right? So autumn, third stage is autumn, stagnating economic conditions because of slowdown, and it will lead to, very importantly, it will give rise to isolationist or protective policies, and it will curtail growth prospects, which is happening right now. If you look at globally in many places, post-COVID, because of the increasing inflation, increasing interest rates, protectionism has set in. Many countries have banned export of food for products and cereals from that country. Even India banned wheat some time back. Many countries have banned because that's the first thing they want to protect their population. And Indonesia banned export of palm kernels or palm oil some time back, and they removed it. And again, I don't know what is the status right now. Then the fourth one is winter. The economy is in problem, and depression happens, and social fabric is into trouble. Haves and have-nots, the Gini coefficient, what we call it, increase in a very big way. What happened in US and other countries in 1930s, 1930, 32, they used to call it ketchup economy. People used to go to the restaurants and they will not buy or order anything. They will just take water and pour the ketchup, drink it and come out. The ketchup is kept free of cost there those days. So that kind of a thing happens, and this is an illustration of the quantitative way. And understanding this will also help us to handle the volatile market and the volatile economy also. Now, how do you identify that last year was a bull market? Always it is easy to talk about it in hindsight. I can go back, today I can tell you that last year the market was at its very high. But how to identify that when it is actually happening? By your experience, it will be easy for you to understand, but it will be very difficult to act upon it. You will really know that the market is at its peak. Market is very hot. But do you want to sell? Most of us won't, because if you sell next day, we know that it is going to go up. It goes up also. So if you sell today, next day you regret that I have sold it. There is no end to it. The problem is because we always try to catch the topmost, the peak, and try to buy at the lowest level. Today I buy, I don't want it to go down even by 1 rupee next day. The reason being that we take it very personal. When I tell you, you may not believe, but we really take it personal. I think that it is very low and I'm buying today. I've done all my homework, all my analysis. If it goes on further tomorrow, which means I'm an idiot. I'm not, we think it is not reflecting upon us. It is reflecting upon someone else who is stupidly selling that stock at such throwaway price. If you feel that this is the right price for the stock and it is available at a discount to it, keep buying it. As long as it is a good management and a capable management. There are two things we should look at it. Good efficient management, that is capable management. The second is good management. There are many companies with honest management, but no point in buying them unless they are also efficient. Being good alone is not enough. There are a lot of companies who are very efficient. On camera, I cannot say that. They are very efficient, but they are not honest. There is no point in buying that company because they are very efficient. So you have to identify a company which is efficient, which has got a very good management bandwidth to tide over a crisis, tide over a bad period, and also a honest management which share their wealth with them. So I cannot tell about a company, but I can tell you about certain groups. But the problem is today I tell about some group, 2 days later some scam comes out of that. So I don't want to mention that also again. But generally, if you look at the general perception, South India-based companies are by and large better companies. And there are many such companies which are available. Now, how to identify a boom or a peak of a market? Now, every investor will become an expert. Nobody will ask what stock to invest to somebody else. And the second significant thing is that a lot of IPOs will start coming out. More and more IPOs will come out. And if you notice those companies, just before coming out, they would have issued a bonus, they would have issued a stock split and divided the share into 10 shares or 5 shares, and then they will price it at 500 rupees and 1000 rupees and they will come out. So that is very clear. And the premium will be exorbitant and people will be fighting to get an allotment of this. Whether it is Paytm or LIC or whatever it is. People will be fighting grab, I don't understand this IPO market. I've never applied for this IPO market in the last more than a decade or much more than that, almost 2 decades. The only IPO applied in the recent past is, guess which company? Huh? Right, what is that company? LIC. Knowing very well that it can come down or go up, most probably it can come down also, but then I applied basically because I wanted a foreigner to buy from, and prevent a foreigner from buying into my company. It may be stupid of me. I can buy only 70 shares or 100 shares, but still I wanted, it's a symbolic purchase. I believe in that company, not as an insurance company, but as a fund manager. I've hardly come across such excellent fund manager who has got created wealth out of stocks. Thousands of crores of money invested into stocks. All the public sector companies, most of the insurance companies lose money in their main line of business, which is insurance. But they keep making money in stocks, their investments, treasury operations, into debt. That's how they all survive. Whether it is United India Insurance, I can name those companies. Most of them earn money if government tells them not to invest in stock markets, all the insurance companies will collapse. But you ask a typical housewife or a common investor, small investor, the stock market is very risky and I need insurance coverage. And he'll go and buy an insurance. Where this insurance company invests, it invests in stock market. So this is a dichotomy or such a situation. So most of the IPOs come during peak period. That's a clear indication that market. 2008 Reliance Power IPO came, and now Paytm and LIC and all those largest IPOs will come at the highest premium, and more people will fight for it. I don't understand this IPO market basically because I don't believe in it generally, because I believe in a market where more number of buyers and more number of sellers are there. They need not be equal in number, but at least there should be large numbers. You have in IPO, in case of IPO, you have only one seller and you have so many buyers. Now he decides what price it is, and none of us are in touch with each other, so we really don't know what value to put it. We don't discuss among ourselves. There is no, the reports are all vested interest, most of the reports. Sorry to say this. So IPO market is a skewed market with one seller and more buyers. It is bound to be flawed, at least 80% of the times. That's if you look at BSE IPO index, it clearly tells you the story where we stand. So this is one indication market is acceptable. Everybody becomes an advisor, everybody becomes a master of his own. Nobody would have tasted loss at all. It would be too crowded, very optimistic, very aggressive. Those days, they used to say that in a lift operator asks the stockbroker that what stock to buy. Then that's a sign of extreme bull market, then you have to be careful. Most of this was visible last year. Last year, if you look at it, more number of IPOs came, more NFOs came, everybody was crowding, trying to grab the market, this thing when the people are willing to partner. But I will not blame them. Why they come? If they come out with IPO at a good premium, a reasonable company, will you buy? Most of us won't apply for most of the IPOs today. Some experienced people do some analysis and they may do, but most of us won't. It will not get that kind of a 10 times over subscription. It will not get that kind of a 5 times over subscription in a lower market. That's why they also come. So the mistake is on our side. How to identify a excessively low market? I have this parameter. When I go to my native place for a wedding, when everyone comes to me and they want to meet me and they talk to me and they ask me what stock to buy, then it is a bull market. When hardly few people look at me or they don't notice me or they just say hello and then they walk off, then it's a bad market. It's a simple indication for me, and it has worked for the last 25-30 years. I've seen it. So this is one way of I'm going to skip all these things. These are all we have spoken about it. Okay, now in this market cycles, in this diversification, we spoke about few asset classes. We touch upon 3 asset classes, how they have performed in the recent past and over a longer period of time, just to understand how the market cycles work and how to benefit from such volatility. Okay. Now this is the price of the gold. Okay. From 2002 to 2009. I wish I had a chart up to 2012 because 2002 to 2012 was the peak. Okay, so it went up from $285. MCX was launched. I started trading at that level. I remember that, and then it went up to $1,850 or $1,800 in 2012. Okay, so you look at the next chart. This is from 2012. You can see the peak of $1,800 or $1,850. You will be able to see that. From that $1,850 in 2012, the troy ounce, it came down to $1,100 in 2016. 10 years it went up, and then next 5 years or 4 years it came down. How much it came down? It came down by 1/3 or 33% fall from $1,850 to $1,100. Most of us in India, if you go and tell your mother or parents, someone, they will not believe that gold price has come down in India. It has come down, that's a fact during that period. But then we didn't realize it basically because we always buy gold in. How do we pay? Do we have gold in India? We don't have. we buy, we import. When we import, how do we pay? We pay in US dollars. Now, when US dollars keep up, then which means when you are importing more gold or more crude, you need more American dollar. When the demand for American dollar goes up, what will happen? The American dollar value goes up. So when you pay more money by American dollar and then buy gold and come to India, naturally the price will be high. It will look high. So that's what happened. So we always think that the gold price keeps going. In spite of that, the gold price came down even in rupee term in India from 3,150 to 2,450 or something between 2012 to 2016, which is a fall of about 20%, something around that. Accounting for inflation, it will be much higher, but I'm not talking about inflation. Everything else remains the same. It is about 20%. Okay. So this is the fall which happened between 2000. But why it went up from 2002 to 2000? One reason is I spoke about what is that? Greenspan, quantitative easing. He printed a lot of American dollars. It was available. People bought. Don't know what to buy. They bought gold and stocks and real estate. The second reason is in 2002 or I think 2 or 3, I don't remember the exact period, SPDF, the company which launched the world's first gold ETF, exchange traded fund, they launched it targeting people like you, the younger generation who don't believe in gold as an ornament, but believe in gold as an asset class, right? You believe in gold as an asset class. So you want to participate in the rally, buy this gold ETF. Every unit of gold ETF is backed up by 1 gram of gold. Now what happened is somebody below 30 or 35 generally don't invest in gold. Not only in India, world over also many parts they don't invest in gold. Parents invest in gold, but they don't invest in gold. Very few probably. But once gold ETF came, the younger people also started buying gold ETF, which is backed up by gold, so they have to buy gold. So the demand for gold went up because of gold ETF and more people buying into gold ETF. And looking at this, India also launched the gold ETF, 2003 or 4, I think first gold ETF was launched in India very quickly. So that started taking it up. Quantitative easing on one side, gold ETF on the other side, and lower interest rate in 2005-6. So people wanted to hedge it with, when they invested too much into stocks, they wanted to hedge it with gold also, part of it. So the gold price went up. Then it came down in 2012 to 2016. Now, one thing what you should notice is 2008, stock markets crashed. Dow Jones came down from 14,000 to 7,000. Sensex came down from 21,000 to 7,900. Okay, 2/3 is lost. 64% fall of Sensex in 2008. But gold never came down. Gold, in fact, went up. It was continuous. So if you have invested in gold and stocks on same time, 2008 you would have lost on stocks, but the gold was going up. Now, what you should have done is booked a profit of a part of the gold at a high price and invest that into the stocks which are available at a lower price. Because next year, 2009, the stocks went up by 65%. Actually 79%. Sensex went up by 79%. From 7,900, it went up to 13,000 something. So 79%. So the asset allocation helps you, the diversification into different asset classes helps you to insulate yourself. And this is one example of that. I can show you a couple of other examples also. Okay. But most of us won't do it. You ask when someone is buying gold, when it is at 4,000, you will not buy, 4,100, you will not buy, 4,200, you will not buy. You'll keep looking at whether it will correct. At 4,300 or something, each one has got a different breaking point. So you'll decide, oh no, it's not going to come down. So let me go and buy. So there are certain asset classes which we all come into and buy only when it goes up. Now I'll give you a typical example. Now you have a couple of lakhs to invest in, but you go and meet an advisor and tell him that I want to give you 1 lakh. This happened in the recent past when I was in another country. Somebody met me and they wanted to invest some big sum, but they said that we'll start with some small amount and let us see how it goes and then we'll invest. So I asked him that let us see how it goes means what? No sir, I'm giving you suppose 1 crore and 6 months later we'll just review the situation. If it is about 1.2 crores or something like that, performance is good, then we'll invest. I said if it is 1.2 crores, I will not invest, I will not ask for any money from you. If it is 6 months later, I'll sell it and give it to you. There is no point in buying when the prices are high. There is no point in investing further when the portfolio is doing very well. Except there are exceptions are there. I'm generally talking, but we all do that. We all invest only when it goes up. We don't invest when it comes down. Actually, we should be doing the reverse. if the quality stocks are there, not in crypto, don't write in crypto, okay? Because I have this GAN or technical theory where they say that if something has fallen by 75%, then it will never ever go for several years. So there are certain cryptos which has fallen down by 75%, so don't touch them. So this is the third chart is between 2015-16 to 2020. The gold which fell down from $1,850 to $1,150 or $100 between 2012 to 2016 went up from $1,100 or $150 to again $1,900 or $2,000. It touched $2,000. It crossed $2,000 in 2020. Okay, so and during this period, if you look at 2016, okay, 2016, the gold price started moving up, but stock market was at its peak. At that point of time, it offered buying opportunity for stocks and gold. That was an unusual event. 2016, nobody expected the market to fall down, but it fell down because of an unusual event. What was the unusual event? Demonetization. Nobody expected. But those are the things, I always keep telling that in India, every bad news is a good news, however cynical what I say sounds. But that is a fact. If there is a bad news and market comes down, use that opportunity to buy an asset. And this is the long chart, long period chart from 1981. 1981 when the stock, that's a spike you can see in 1980-81. During oil crisis, the stock price went up to $850. Gold price went up to $850. Oil price also went up. During that time, gold price went up to $850. From $850 in 1981, it came down to $285 in 2001. 20 years, the gold price was coming down continuously in global market. But as we keep telling in India, that gold price has always gone up. Okay, so it is a myth. The dollar value has gone up in India and that got reflected in the gold price. But whatever it is, if you are an investor in gold in India, you would have benefited indirectly because of that. So the best way to invest, if you're looking at gold as an investment product, the best way to look at or invest is sovereign gold bond because it gives you 2.5% return. In the 8-year period, it will be 20%. Whether even the gold price comes down by 20%, you're compensated to that extent, assuming that gold price comes down, which is a rare occasion. Okay, then the second benefit in buying in sovereign gold bond is that the tax benefit it offers. On the 8th year, when it is redeemed, there is no long-term capital gain on it. So to that extent, there is a tax benefit on the capital appreciation. There are a couple of other benefits, but still I have some of the investors asking me, sir, on the 2.5% tax revenue. You still invest in the, this morning I went to a shop to buy a gift for someone who likes gold. So I went with them and believe me, the shop was buzzing with activity. 10:30 in the morning, they opened only at 10 o'clock, 10:30 in the morning, the shop, the gold jewelry shop, it's a very big shop, it was buzzing with activity. There was no one to attend to us. We had to wait. And we say that recession is going to come in India. It's not a food shop. I mean, you go to a hotel or restaurant anywhere, you cannot get, what is it, the new one, Bangalore tiffin room or something they opened, or you go to any restaurant or any resort, you don't get a booking. And we talk about recession. Recession is there for some of the Western countries, maybe not for us. I don't believe in it. So similarly, we have this attitude, sovereign gold. The morning, the story was, morning when we bought the gold, he was working out something. I could not understand anything because still they use the paper pad clip or something. He was working out something with the calculator and he said something and then 20%. I asked, what is this 20%? So 20% is a making charges. I think making charges. Then what is this 4 grams? He said the 4 grams is a wastage. 4 grams for a 20 gram product. The Bangalore or something is 20 grams and 4 grams wastage. And add these two. Then something a GST, 3%. And he was talking about this GST where, sir? I said, GST is only 3%. You are taking 20% and another 4%. No, sir, there are another products, the GST is some 12% or something, he said. 12% or 18%, I don't know. Since I don't buy much of gold, I don't know what it is. But the point is, if you have decided to invest, as a part of your asset allocation, 5 to 10% in gold, the best way to invest is sovereign gold bond. If you are a trader in gold, you have to look at gold ETF. But if you want to touch, feel, and enjoy the, holding the gold, then ornament, that's a different thing. That's not an investment because have you ever heard of anybody selling that, okay, gold price has gone up from 2,000 to 4,000, so let me go and sell gold? Nobody will sell the gold. then how can you call it as an investment if you are not going to sell anything? I mean, anything. In case of emergency, it is useful. I mean, what kind of supportive arguments are generated in support of gold? No? Suddenly, then they will say the stock market is risky. I'm not talking about stock market at all. I'm only talking about gold. We'll go to stock market when that topic comes in. What mistakes we do in it, what problems are there associated with stock market. By talking something factual about gold, it does not mean that I'm against gold or I'm for gold. Simple example, I keep telling this in the same hall I've told earlier also, is that who is richer? The fellow who sells gold or the fellow who buys gold? Go to T Nagar and see who is rich. The jeweler who used to sell gold in the one-story building, now he's got 8-story building. It's quite obvious that they become rich and we remain the same. We don't because the best thing about gold is that it doesn't make you poor also. The middle class in India remains middle class thanks to gold and real estate. If gold and real estate is not there, where will they put their money into? Gold is beaten in. It is in line with inflation. Real estate has beaten inflation. But at the same time, the gold and real estate are the reasons for middle class remaining middle class. Otherwise, we could have gone up. Because of over-investment into gold, over-investment into real estate, and not participating in the other asset classes, which we perceive as risky. Now, the simple logic which I want to put to everyone is that we think, why do you ask a common man, why do you invest in gold? But I can touch and feel, I know about gold, I don't know anything about stock market. Now, I'll tell them that I'll remove and give this. Tell me this is 24 karat or 22 karat or 18 karat. Can you tell me? You don't know anything about gold. None of us know anything about gold. And we say that we know everything about gold. So we are investing in gold. Why are we investing in real estate? We know everything about real estate, sir. It is very safe. Now you tell me what is patta and what is parent document. Then when patta and parent document are there, why do you also need a chitta or a form B or several 10 documents you need? Why? And after having all the documents, one party fellow will come and occupy your land. Why do you need it? And we say that we know everything about real estate, we invest in real estate. Now you tell me, you all have a paper and pen? Or at least, you can open an Excel sheet in your mind. The first column is the time at which you wake up in the morning. The second column is the activity, what you do. The third column is the product needed to do that activity. The fourth column is the price of that product. And then the fifth column is how many units you use in a year. And the next column is total value. And the next column, you write down your age. And in the last column, you multiply that. So which means this many years you have used this product. Right. Now let's start with at what time you get up? 6 o'clock. Seriously. You're doing CA. Okay. Because my son used to get up at 5 o'clock and 5:30 he will rush for the class. These are the only peculiar people who leave at 5:30, attend class from 6 to 9, and then come back home and the father is leaving to office, and then again go back in the evening at 5:30 for the class and come back at 9 o'clock, right? Very few people. So, 6 o'clock, what do you do first? Look at WhatsApp. Huh? I don't want to harass you. I'll tell you what we will do normally, generally assume that we'll do this. We'll brush, right? I'm not talking about the way, even I look at WhatsApp first, but that's a different thing. But we brush. So write down 6 o'clock, brushing, the items needed for brushing, toothbrush, toothpaste, tongue cleaner, and then dental floss, right? Then on the other side, you write the number of units used in a year. Then you write the price of it, multiply that, and how much you have used, and your age, multiply that 20, multiply that by 20. So one single activity which you do in the first 5 minutes of your day, you know that how much you have paid. Can you tell me approximately how much you would have paid in this last 20 years for a toothpaste, brush, dental floss, and tongue cleaning? Few thousands or several thousands you must have spent. And take it for multiply by 4 for your father, brother, sister, and In a typical Indian family, you would have spent probably a lakh. If your father is 70, 80 years old, you would have 5 minutes of activity. This family has spent more than a lakh. Now the next activity is applying a coconut oil. Which company is making it. On the right side, you also write which company is making it. If it is a Colgate or Signal, whatever it is. And on the other side, coconut oil, which company is making it. And the next 5 minutes, you are going to drink a tea. Now, Three Roses or whatever company is making the tea, and what is the sugar you are using, what is the milk, what is the price of it, how many tea you have drank. My friend told me that I have drank about 8,000 teas in my life. Then multiply that and find the value. Then the next 5 minutes, you're going to read newspaper, which companies, there are some listed companies. So newspaper, this is the cost, this is much. So, okay. Then the next 5 minutes, you're going to take bath. This is the soap I'm using. This is the shampoo I'm using. I don't use the shampoo. So this is the shampoo I'm using. This is the conditioner I'm using. Then after taking bath, they come and switch on the fan. What is the fan? If you look at it in the first 1 hour before you leave for your CA class, what are the products you used and how much money you have spent in the 20 years. And if you're going to live for 90 years, I always shoot to live for 100 years. So next 80 years, how much you are going to spend on it. Then you're starting, go to your class or office in a bike. What is a bike? Suzuki or Honda or, or if it is a bus, it is a Ashok Leyland bus or Tata bus, right? And then on the way, you're filling your petrol tank with HPCL, PPCL, IOC. Now you tell me that if you multiply all these things, what is the kind of the profit they are making out of you? Approximately 10%, 20%, 30%. How many crores this will come to? Now, if you tell me that I don't know how stock market functions, is it believable? These are all the companies which has become very rich because of whom? Because of you and me. You and me don't know much about gold, you don't know much about real estate, but we all know about these companies because these are the companies whom we made rich. They bank on us. And we say that I don't know anything about stock market. Is it acceptable? Is it understandable? What we don't know or we are not able to understand is the price factor. That's all. How it moves, on what basis it moves. That's why I said that the behavioral finance. You should try to understand how it happens, how people behave in different mindsets. Because you're all of same age. You're all in the same classroom. Let's say that you're studying +2. Same MPCB group or what you call the maths, physics, chemistry, biology group you're studying. Because that's where the more options are there. You're still confused and you don't know what to take. So you keep all the options open and do the first group. Same teacher comes and takes class. Same books. But all of us, do we get same marks? We don't get same marks. Why? It's each one's understanding, how we interpret it, and our understanding capacity and interpretation capacity. Same thing with the market also. Even if information is available simultaneously to all of us, how we interpret it, how we use it, that is the. I remember someone telling that when one Indian company, started making toothpaste. Somebody said toothpaste market is going to be flooded. I remember one of the MNC, the other guy said that we don't expect any competition from them basically because Indians are improving in the hygiene. They say now most of them have started brushing in the evening also. They are going to start. So our volumes are going to double. Now this is one way of looking at the market and the stocks, right? Now there are different ways of different perceptions of looking at same information. Now, for example, if there is a GST on a product, the sanitary napkins. Now, everybody fought against that GST, except some of the GST manufacturers themselves. You know that. Finally, government removed that GST, which benefited only the same typical multinational corporations or corporates, which most of these people fought against. It affected those small manufacturers. You've seen Batman movie. It has affected those small manufacturers in Coimbatore, in smaller villages who are turnover coming under 20 lakhs. So they didn't have GST, whereas these big companies had GST. I'm not saying that people go to the different brands because of GST or not GST, but then there is an element of the price variation comes down. So it has affected a certain set of people. So contrary to the belief that removal of GST on a particular product benefits the industry, it is affected as a certain section of the industry also. So how we interpret it, that is very important. That is where investing in the market is something like there is a book, I forgot the name of the book. It is something like Sherlock Holmes way of investing in the market. If you've seen the Sherlock Holmes movies, most or read the stories, I have grew up reading the stories. So the moment he enters the room, he will notice what no one else has noticed. And that is where the success is there. Even in stocks, it is the same thing. What somebody else is not noticing, if we are able to notice it early, and then we can make money in the markets. That is important. Now, the next asset class, we discussed enough about gold. The next asset class is that real estate. And real estate also, again, nobody will believe that the prices have come down. But now people have started believing in the last 2-3 years, they've started accepting also. There is an apartment in Weimar, which sold 10 years back at 4,000 rupees, 4,500 rupees a square feet. And today, even today, they are unable to sell the third phase, they are selling at 4,500 rupees. Near Sholing, one of the inroads. It's a very big project. I don't want to mention the name. But they advertise at 4,500 rupees and they are selling it. What it means, 10 years later, same price they are selling, which means if you account for inflation, all the opportunity lost by putting it in a fixed deposit at 8% or 7% return or 5% return. And this is the RBI data which gives you the red one is nominal and the blue one is real. How the price behaves, annual change in the housing price index. So there is a skewed trend in the demand. The demand has come down substantially in the last 10 years. You could notice it, when I came to Chennai first time that we used to book, there was a company called Electric, very good company. Highly ethical practices they used to have. And when we book an apartment, we used to wait for 2 years to get our 1.5 years. And today you can walk into most of the apartments, it's ready, already built in, and you can pay the money and check in it afternoon. That itself clearly tells you that the market is flooded. Of course, I don't expect it to continue in the near future. I think maybe in a year or 2 years down the line, the real estate is going to pick up in a very big way as a part of the revival cycle. 10 years it is down. Now I think it is flattening out and slowly trying to pick up, and we hear the prices going up in a few pockets in smaller towns. Surprisingly, because of this work from home and other things happening, people are they've started buying in other places also. So real estate also had its own cycle. 2092 to 2008, it went up. 2009, 10 to 2020, it was coming down continuously. If you had all your money into real estate, even in real estate, I remember what my father did. He bought in my town. He bought plots in all the 4 directions. He said, they keep saying that the Tahsildar office is going to come in that area. They say that RTO office is going to come in this area. So buy in all the 4 directions, whichever goes up will be benefited. Right? So real estate also. Now today, expanding into real estate investment, even for youngsters or in a small amount is possible thanks to real estate investment trust, REITs. So real estate, there are 3 REITs are available in the market: Embassy Parks, Brookfield, there is one more. 3 real estate investment trusts are available in the market. If you have really had a diversified investment all along the last 3-4 years, if you have noticed it, last year when the markets went up, stock markets went up, all the REITs were trading at a lower level. Brookfield was 275 or 280, Embassy was 310 or 315. Today, all the 3 REITs, real estate investment trusts, when the stocks have come down, the shares have come down by 25-30%, Nifty has come down by 20% or 25%. All the REITs, 3 REITs have gone up by 25%, appreciated by 25%. So here again, if you participate in the cycle, if you have a diversified portfolio, it has helped you. So I look at my portfolio as 5 to 10% in REITs, 5 to 10% in gold, sovereign gold bond or whatever it is, another 75 to 80% into equity with some investment in hybrid funds also. So all our practices are running good. Yeah. Just to give an example about the behavioral finance or psychology of investing, I think 2 examples I'll give you. You can look at that. Have you ever noticed this? You're able to read it? The red one is the pain from the loss of 100 rupees. If you lose in a transaction, you invested in stocks or crypto, whatever it is, if you lost 100 rupees, there is a pain. If you gain 100 rupees, there is a joy. Both are 100 rupees. But if you notice, the pain is more than the joy. Right? At least more than 75%, all the research has done proves that more than 75-80% of people, the pain is more. Though you lose 100 rupees, the pain is more. But then again, 100 rupees, the joy is less. This is something which is a peculiar thing which you will enjoy. I mean, really realize only when it happens to you. And there are a lot of other bias. You can go back and do your homework on confirmation bias, availability bias, anchoring bias, campus fallacy. For example, confirmation bias. You've already decided last year that crypto is a good investment. Now you come and ask me that this crypto is a good investment. I say it is not, then you call me a old man. But if 2-3 people tell you that it's a good investment, then you don't even want to know the reason. You feel happy that it's confirmed. Okay, more number of people are saying that it is a good one. But we should also understand that certain things goes up. Let's say that 100 people are in this room, and all of us need a pen, and there is only one pen. The price of the pen will keep going up. If 100 pens are there, the price of the pen is not going to go up. It also tells you another way that the fellow who buys the pen finally has not paid the proper price, has not paid the real value, he has paid a premium, right? Next day, if 99 pence come, the value of this goes down. So this is something which we should look at. Anchoring bias is simple. Our mind gets anchored to a particular number, certain numbers generally, and it always revolves around that number, and it looks out for confirmation bias in that numbers. For example, if he has invested, he looked at 60,000. Bitcoin went up to 60,000, peak 60, right? Or 58, 59. But the moment it comes to 50 or 40, you'll feel very comfortable to invest in it because your mind is anchored at 60 is very high, so 40 is cheaper. But when it comes to 30, there is a challenge. Somebody who enters at 30 will think 20, who looks 30, it comes to 20, you'll think 20 is good. So your mind gets anchored to certain numbers without any sound validation process. Okay, I'll give you one example. Now you want to buy a television, and the television is about 10,000 rupees, right? And the television is available in our what is that mall next to MOP College? Hispanic Center. It is available at 10,000 rupees. The same you go and buy, and by buying, he says that, sir, our godown is in Velachery. If you go there, you will get about 10% discount, right? What will most of us do? I'm not asking about exceptions. Most of us will go there, right? We'll go and buy because we get 10% discount. It's hardly about 7-8 kilometers from here. You go and buy it from there. Now think about another situation. You want to buy a car, and the car showroom is just outside here, and the car is priced at 10 lakhs. Now you go and ask him, then he says that if you take delivery from here, it is 10 lakhs. If you go to Velachery or workshop is there, and same terms and conditions, same quality, the same car, we'll give you at 9,99,000 rupees. We'll give you 1,000 rupees discount. Will we go? We won't go. Most of us won't go. Why?
We are investing lump sum amount and we won't consider that 1,000 rupees.
For us, the 1,000 rupees looks small.
The 1,000 on 10,000 is being compared to 1,000 on 10 lakhs.
Yeah, correct.
The proportionate was very small.
Proportionate is very small.
But the effort is equal.
Effort is equal, but the proportion is too small. But is there a variation between the value of this 1,000 and this 1,000? No. Now what we should look at is how much I save. I get 1,000 rupees in this, I get 1,000 rupees in this. If this 1,000 rupees is important, this 1,000 rupees is also important. If this has got some value, this has also got some value. But our mind is diverted very cleverly by looking at 10 lakhs. Now our mind should be anchored at 1,000 rupees. Instead of that, our mind is anchored at 10 lakh and 10,000. So for 10 lakhs, 1,000 is small. For 10,000, 1,000 is big. Now this is the problem. Now who uses this? Many people use this. Pizza. Now they've changed it. They're very clever. They've changed it because the book was written about it. I think Predictably Irrational, somewhere they've written about this. If you typically look at originally when the pizzas came into the market, if small is X size, the mid size will be double 2X and large will be 4X or 2X of the mid size. This is how it used to be. Price also will be 100 rupees, 200 rupees and 400 rupees. Now these pizza companies, what they did was, they noticed that most of us order what size? Medium. Because large size we feel guilty, it's a junk food. A small size is not enough. So most of us ordered mid-size. So how to make money out of this? They kept the price middle, but the size not middle. Size was little lesser than the mid-size. So they started making more money out of this because of the bias what we have. We think middle means it's a mid-size or mid. This is one example. Another example is that it happened in my life. I went out with my children to buy dresses, and morning we went and not unusually, I think my children are very fast in deciding. My wife is very fast in deciding. They bought their dresses within next 1 hour in a shop. For me, it was not available, so I went to the next shop, and then finally around 1 o'clock, all of them were tired and ready to have lunch. That is the time we spotted a shirt. It was very nice, and I looked at the size. My size was 40, it was 38. So we debated, discussed, and all. The family was forcing me to buy. No, it'll be all right, please buy it. Because that's the only design I like. The shop owner came to me. The shop, I still remember, the shop was called Rex. Last it was there. I think it is no more. They closed it. They're good guys, good promoters. So they came. It's a big shop those days, and he came and he said, "Sir, what is the problem?" I said, "My size is 40. This is 38." So he immediately took it. What brand? Let me see. Sir, Zodiac. This will expand actually. That's all. I also decided. Family also decided we'll buy it, and we came out. It's called nudge. In behavioral finance, this activity is called nudge. The pizza companies nudged you to buy medium by making you feeling guilty to buy large, and small is not enough. Similarly, this guy nudged me to buy this shirt. So I was telling my family, invariably after that it was not fitting me at all. It never expanded. It went along with another 5-6 shirts which I never used for the last 6 months. I told my family, had it been 42, you know what that guy would have told? It will shrink. And we all wanted only that confirmation. Our solita, okay, no, it is fine. I cannot. So we buy. Now this concept is very well written as a book called Nudge, N-U-D-G-E, by Richard Thaler. Richard Thaler was given a Nobel Prize for this research 3 years back, I think. And it's a nice book. So don't worry that it's a research scholar and all those things. It's a very nice book, well written book, simple book, writing about this kind of nudging what happens in and around us. After +2, when a fellow friend takes a course, we are indirectly nudged to take that course. Or, everywhere we are shaking your head like anything. You are nudged. You are nudged to do CA. So that's it. I think you have to read. It's a very interesting subject. See, one more thing I'll tell you. This is something not directly related to this, but then how a logical deductive mind works. You've seen this example? Anyone of you have seen this? But read this. World War II. The German planes. In Germany, the planes were shot, and they analyzed the data, and they tried to chart a pattern, and they looked at this pattern. From this pattern, they came to a conclusion that when the planes go for war and they come back, then they analyzed and found out that most of the planes were hit in the wings and the belly, and to some extent in the tail. So if we strengthen this parts, then we can fight the war much better. Is it the right analysis? Don't go by the way I asked the question. I asked the question, the way I asked also maybe a leading question. Is it the right way to analyze the problem? These planes, let's say 100 planes go, and some of them come back, some of them don't come back. So they analyzed the planes which has come back. Most of them were hit in wings and hit in this thing. Because of the problem, they cannot fight and they come back. Now they decide that we have to strengthen the belly and the wings and the tails. Is it the right analysis? This is what they came to a conclusion. More damage was seen on wings and body, so we have to strengthen them. But then there was a Jewish statistician, a Hungarian Jewish statistician, Abraham Mal. He said, analyze the total number of missing planes vis-a-vis the planes which have come back. Now, the very fact that these planes have come back means wherever they were hit are very strong. Don't strengthen them. Most of the planes did not come back because they were shot on the nose. That's why they didn't come back. Now, this is a very different way of analyzing things. Most of us don't look at this. So, cockpit and engine is something which was hit, and because of which the planes could not come back and they've fallen there. So, you have to strengthen that. And this is the market cycle. Those who have been in the market for the last 3 years must have gone through all these things. Hope, optimism, belief, thrill, euphoria, complacency, then anxiety. The kind of the interest we take in the market and in the stocks when the market is going up, and compare it with the kind of the interest we take when the markets are coming down. We lose interest, right? We totally lose. We don't even want to look at it. But actually, that is the time to look at it and go for course correction and look at why it has come down. If there is no reason and for which if it has come down without any reason, it is a time to average it, time to buy it. Now, where will I go for money? That is where cash conservation come in. That is where always you should be in cash. If you look at me personally, last 1 year, I've tweeted about it also. Sometime around Diwali, I started selling. 6 months, I've been continuously selling. Market was going up. I was like a fool. Many of my friends were telling me that you're not participating in the this leg of the market. I don't want to participate in the leg of that market. I know that market is overvalued. I know that it can still go up also, but I don't know where it will stop. And I accepted my ignorance or my lack of knowledge to predict the peak. But then I was very comfortable getting out and being in cash. The only stock I bought on record is ITC. And everybody, again, it's a meme stock. Everybody started laughing and they said, it's a stock one which has not gone up for last several years at 200 rupees. And the same stock is at 300 today, and they've given meanwhile two dividends at 11 rupees or 10 rupees 70 rupees. I should have gone wrong also, but I didn't mind because see, I'm looking at the MRP of a stock, and if it is available at a discount, I'll keep buying. If it is available at a premium, then I'll keep selling. That's a simple facility to use. So I'll be happy to take more questions from you than talking about it. So finally, I think it is important to tackle this volatility. You need a mentor. Until you become confident that I can tackle this emotionally. I repeat it, most of the time people like us act as a mentor or guide or do financial counseling than advising them. Many times people come to us wrong time, they want to withdraw money. Now the market has come down by 30%, I don't think it is right to keep the money, let me take out the money. That's the time we talk to them that don't take out the money. There are times when the market peaks out like last year. I was struggling. Look at me, I'm a market intermediary, semi-regulated intermediary. I'm telling my clients that I don't need business. I don't want you to buy. There are a lot of other people who can tell them to buy whatever they want to buy. It's very difficult. I'm telling you, it's very difficult. Difficult on two counts. One is you may lose your client also because he sees that the market is going up from yesterday to today and today to tomorrow for the last 3 months or 6 months, and that's a long period for him. Whereas I keep selling, I want him to sell, put profits and take away the money. So it's very difficult, and I may lose my client. I can do that. I can, if I can afford to do that. The interest of the intermediary and the client matches rarely. If it matches, the client is lucky and the intermediary is lucky. Most of the time, it doesn't match. That's a problem. So you should have a mentor or the mentor does not straight away tell you buy this stock or sell this stock, but he is like more a sounding board. Even if you are knowledgeable, he is more like a sounding board. Go and tell him this one. He can tell you that okay, you are right or you are wrong. Why you are wrong? And discuss and debate. That is something which is needed, and you should have a study circle among yourself and keep reading, watching, browse, and a lot of interesting tweets. I think there is one guy called Neeraj Marathi in Twitter. Every day he tweets one interesting read, an interesting article. He curates it and very sincerely he does it. He's from Pune. I was lucky to attend one of his sessions in Flame University in Pune, where he said the funny things about the annual reports and balance sheets, what happened year after year. He picked up a couple of companies where what they said in 2008, same thing they talk about in 2008, it is 2010, 2012. It's a copy paste of same paragraphs. We are working on business improvement, we are working on, this, that. Well, nothing has happened. So these kind of things. So you can track such kind of people in Twitter IT. Aswad Damodara, valuation pro, is very interesting. He talks a lot about last year. He tweeted a lot about ESG investments and those kind of things. And a lot of movies are also there. One of the old movies, OPM, Other People's Money. Danny DeVito was actor, and that's about one promoter, 100-year-old of a 100-year-old company, third generation management promoter. and the share is trading at £2, and a takeover guy comes and how he creates value out of nothing, and the fight between them, all those things. And so, a couple of good movies are there, like the first one, Wall Street, not the second one. If you read the second one, Wall Street, you'll have a bad opinion like about people like me. And learn to filter the noise. That is very important. Today, you keep hearing whether it is so many business channels, so many business newspapers, and so you should know. You should not close your ears. You should get everything, but then you should know how to filter the noise. That is very important. FOMO. Howard Marks is he heads Oak Tree Capital, and he writes almost as good as Charlie Munger. There are two people who write really very well. Though many of us talk about the Bible of investment, security analysis, and so. But I think the interesting book is Charlie Munger's book on the Poor Charlie's Almanac. If the readability quotient is not good, I never touch those books. So these are some of the books which Howard Marks is a very interesting writer. There's another book which was released last year, Psychology of Money, Morgan Housel, who writes for Fool.com. That is a website, Motley Fool or Fool.com. He writes regularly. The collection is published as Psychology of Money. So Howard Marks talks about the fear of missing out and comparing ourselves with others. The most of the problem happens when we start comparing our return with others. To some extent, it is correct. When I'm coming to markets to invest, I should be prepared for the volatility because market is not going to give me linear return. It will give non-linear return, volatile. Sometimes it will give negative return. But whereas fixed deposit gives me linear return. That gives me a lot of comfort and safety. And if I'm happy with that, I should stay with that. Because I always say that there are two ways of becoming rich. There are two ways of being happy in this life. One is make much more money, and still sometimes you can be unhappy because you may need, even if you make more money, you may need much more money than that. So there is no end to it. The other way of being happy is that make 1 rupee more than what you really need. You can be happy. So being contented and reducing your needs, reducing your requirements, going for minimalism, going for the concept like freeganism, concept like buy nothing day. So you keep adopting some of those concepts, you can be happy. You can still be happy. Money has got nothing to do with happy. I don't know how many of you are listening. I have not listened to that speech of Rajinikanth recently, but somebody told me that he says, in spite of having earned so much, I don't have peace of mind or something like that. So money does not brings in. That's a misconception. There are people. You see the child, or you see many people without money, so happy with so much of money. People are not happy. Certainly, money buys quite a lot of other things, but not happiness. So I think you should not compare. When people come to us, they say that sir, we are getting 5%, 6% return in fixed return instrument. I'm happy if, because I'm taking risk in the market volatility. I'm happy if I get 10 to 12%. They do get 10 to 12%. It is a no-brainer. The market you can get easily 10 to 12%. Index gives you 15% return. If you simply invest in return, it has the last 30, 40 years, it has done 15% return. Okay. But even if they get 12%, what they say is that even the index gives 15%. Now 12% is not enough. Now the goalpost is shifted to 15%. Next year you get 15 or 16%. Now they say, no sir, that fund manager has got 18%. This 15 is too low. Now that's where the competition comes. We should understand whether we are running 100 meters or a marathon. If I'm running 100 meters, I should compare myself with 100 meters. If I'm running a marathon, I'm doing a financial planning for my 20 years or 10 years down the line. I should not be comparing myself with somebody who performs in 1 month or 10 months or 6 months. I should be working towards long run. So this kind of wrong comparison puts pressure. Think about a scenario, your ITC has not moved for the entire 1 year last year. Whereas many other stocks have multiplied like anything. Zomato has gone up from IPO at 80 rupees, went up to 120, listed at 120, went up to 140 or 160. You'll be feeling very bad, right? But if you have invested in Zomato and not in ITC, what is your situation today? On the contrary, if you have sold your Zomato and invested in ITC, what is your situation today? So, of course, when it comes to individual stocks, it's very difficult to predict. Overall market, we can always say that that's not a problem. In short, I think this is in Insta, this napkin finance is there. He tries to explain every concept in a that tissue paper, whatever you get in the restaurant, he tries to explain it in a simple way. Like there's another one. And any questions are there? I'll be happy to take. No questions?
Yes,
Yes, sir.
just
Yeah, please.
say one of the members of the investor awareness program when it was started
Okay.
in 90.
Yeah.
I'm an investor in stocks also from 1973. Okay, my point is you are given various avenues of investment. What is you said about stock, you said about dividend, you said about gold bonds, you said about real estate. Normally, when you say it is investor awareness, you go with the stock market only. That is fixed in our mind. Now we find that what we have invested earlier, it was a public money. It was registered with SEBI. Now they are gone away from SEBI. So we don't get much information about it. One. Number two, of the recent legislations, most of the corporate sector, they don't respect the investors because they don't send even annual report. They send even resolution. Such is the case. How the investor awareness can help in getting the more information. For example, I tell you, the Jet Airways, which met with which collapsed, I say it's collapsed, which was raised in the annual money in 1996. SBI kept quiet. They are the big stockholders. They kept quiet, they did not take action. Like that, many things happens in stock market. What is your advice for this? Will you take up it SEBI to protect the interests of small investors?
Yeah.
Then I ask.
Yeah. Sir, investor protection is a continuous process.
Yes.
Okay. Now, no company was ever registered with SEBI. Okay. All the companies were registered themselves with the register of companies and then listed in the stock exchanges,
Yes.
and they have to comply with certain disclosure norms. It is true that some of the companies were not disclosing fully, and because of which they were delisted or transferred to other categories, Z category or whatever it is, and it happened. Though there should be a good regulator, and out of the 4 regulators, I felt SEBI is the next best regulator to RBI than IRDA and other thing. Please don't take me wrong, but they're one of the rest very reputed regulators, and they're doing a fairly good job. In spite of that, there are a lot of problems which are coming. It is a continuous process. As more and more problems comes, they will refine themselves. Specific instances, I cannot address about it or talk about it right now. Through Tamil Nadu Investor Association, like institutes, we've been taking up many things to them. In fact, to the institute, I will be appealing to them to take up this, not 26 years, AAS. In AAS, there is a peculiar problem for a small investor, an average investor. Suddenly, he says that he sees that there are certain stocks are bought and sold in his account, whereas he has not done like that. When you really look into it, for example, Wipro came out with a buyback of 450 rupees last year. So somebody offered at 450 rupees. On the last day, he noticed the market itself was trading at 475, so we withdrew this. Now, they take the data from CDSL. So they think that this guy has sold 500 Wipro and bought back again, whereas he has not done anything like that. But in 26 years, AAS, it is coming as a bought and sold, bought on such and such date, again sold on such and sold and then bought. So these kind of issues, and the dates are also always the rate what they take is 2 days later. Because if I sell today, the delivery comes is taken only day after tomorrow. On that day, they take the rate and they compare that is at your turnover at all. So these are some issues which they have to address over a period of time. But my simple suggestion will be to not even to look at when there are about 3,000 choices in the market. Why we look at the choice which is unpredictable, whose promoter's track record is not known, and all. It is true that the regulators regulate that company. Also, they are regulating. Also, there are problems. But as an investor, one way to protect myself is that I will avoid such companies, fraudulent companies, or Sometimes you may say that fraud comes to limelight only after they commit it. So I will go by a company with a fairly good track record over a longer period of time, how they behaved in times of crisis, how they behaved in times of frauds detected in their company, how they handled it and how they came out of it. So those kind of preventive measures as an investor, I think we have to do. That's what I personally feel. See, there are some cautionary flags which we have to keep on looking into. If there is a frequent change in the top management, that's a challenge. We have to worry or be concerned that why there is a frequent change. Suddenly, the independent director or auditor resigns. Why is he resigning? Okay, whatever explanation the company gives, we have to be cautious. If the promoter pledge is very high, why is it very high? Promoter stake sale happens, suddenly there is a reduction. These are things. And the company gets into litigation very frequently with the vendors or with someone, anybody. That's a problem. And apart from this, from the accounting point of view, a couple of things I can add. There is a mismatch between the cash flow from operations and the operating profit. If there is a mismatch, I think that is something is a cautionary flag one should be look at. And also look at accounts receivable to sales ratio. Sales is there is a company in Chennai which is, I don't know whether it is still listed. Their sales will be growing quarter on quarter. But then the receivable is also going up. Money is not coming from their buyer in Singapore. That basically because that's also their own company, some shell company. So they send an order for 10 crores. Next quarter they send an order for 15 crores. This people say my turnover has gone up, and it's IT company. So you send a floppy and say that you have exported or you provided a service and bill them, but money will not come. So accounts receivable to sales ratio is something important, and bad debts written off to sales ratio. Contingent liabilities as a percent of net worth. These are, though it looks complicated for a non-finance man, it is not all that difficult actually. You can find out and look out for strong management pedigree where the transparency or corporate governance levels are good. I think that is the only way to protect ourselves.
Mutual funds.
Sorry?
Mutual funds that you have not touched about.
What is it you want to know about mutual funds?
Mutual funds, see stock market is going up, mutual fund is down.
Yeah. No, the mutual fund is also, NAV is also coming to stock markets. Actually, stock markets have come down in the last.
Only you see stock market, the basic thing is they compare the rates going up or going down related to the US dollar. Otherwise, in reality, it does not happen.
I don't know, sir. I think what I see is stock market has come down by 25%, Nifty index wise. Mid caps have come down by 50%, some of them. I think that is getting reflected in mutual fund. Mutual fund is not a standalone product. Yep. Someone else from the students?
What is your opinion? Will you recommend public sector banks? As long as it's champ, recommend or recommend page.
I am very positive about banks as such, particularly public sector banks, because they are undervalued right now, most of them. Though they have gone up in the recent past and all, but then they are undervalued. So what I did about a year back, when no one was noticing it, I bought into Nifty, not Nifty, PSUBs, public sector undertaking, when ETF was there. So PSUBs, I bought CPSE ETF, I bought around 17, 18 rupees, or I think right now is 33, 34 rupees. It has appreciated substantially. So you have to wait for some time and then start picking up. But I'm, because simple reason, most of the bad debts are written off. The new set of NPA will start after 5 years, not now. So you can, the next 2-3 years, couple of years, I think banks may do reasonably well, particularly public sector banks, frontline public sector banks. Don't go for weaker banks. But if you want to place yourself strategically, and it's only a guesswork, most of the time government tries to merge weaker bank with a stronger bank, in which case the weaker bank is the beneficiary as a shareholder, if you look at it. The stronger bank is a little bit affected. So that way, if you look at it, go for a weaker public sector bank. But otherwise, the stronger public sector bank, the top 3 or 4 will become even more stronger because of these mergers. And you all know that when the government says it, they mean it really, and they will somehow get it done. And when that happens, it will strengthen their hands and they will become more efficient, lean, and the expenses will be controlled. See, today we have more than 25 or more than 25 or 30 chairman, managing director, executive director, in every bank, then another 10, 15. All these things will be consolidated and it will become not only the employee cost, there are various other things will come down. In my street where I am there on TTK Road, there are 4 or 5 public sector banks. And one public sector bank, their branch is there within this side 2 kilometers one, this side 2 kilometers one, here one. Three branches are there within CP Ramswamy Road, there is one. Eldams Road, there is one. On the other side, there is one, this TTK Road. So, why do we need so many branches of the same bank offering same products, same investment products? And banks have deviated a lot in between from being a banker into other, they become a distributor or trying to leverage upon the database what they have, but without realizing that they don't have the management bandwidth for the same. They cannot ask their employee who specializes in banking to sell gold, sell insurance product, which is totally not aware of it. He poor thing, he will come and plead us, sir, for at least for me, you put this. I mean, what is this? That's not the kind of the marketing. They were doing that in between, whereas they lost heavily into their main core business, which is borrowing at low level in fixed deposit and lending and monitoring the lending process and recovering the money. They failed miserably. Now I think they will be back in line at least for the next 5 to 10 years. After that, again, these are all, it's a cycle. Again, scam will happen, again, NPS will go up. It's a cycle, but we'll fine tune the system. I'm bullish, reasonably bullish on the stocks, public sector. Or for that matter, PSU companies itself. There are some upstream or downstream oil companies also. Downstream companies which have paid 20% dividend, 20% yield last year. The dividend yield is 20%. If you look at their thing. So there are many such public sector companies, oil companies, and available at a throwaway price with a lot of other hidden this thing because of the valuation asymmetry in different things. See, the last year was a period where the OPEX versus CAPEX. So everybody wanted a company with higher OPEX and less CAPEX. Which means whether tangible asset or intangible asset. People went for Paytm, Zomato, these kind of companies. Now that is changing. Now no VC or nobody wants to touch such kind of companies. Now they are looking at companies with strong asset base. Now this cycle will change after 1 year, 1 or 2 years when the market goes up. But bankers will be benefited out of this process. Thank you. Regarding just one slide before I conclude, for some of you are there in the market, so I'll tell you what I do to assess the broader market, whether it is high or low or somewhere near. So the price to equity, price to earning ratio, PE ratio, is somewhere around 20 right now. Last year, same time, it was 28, and last year peak was 35. From there, under March 2020, the low was 17.15. So if you compare with last year 35 or 28, we are cheaper now. But if you compare it with March 2020, we are slightly expensive. My opinion is as long as you're 30 and above, P is 30 and above, it is dangerously overvalued. 25 to 30 is overvalued. 20 to 25 is fully priced. You don't have an opportunity for appreciation. And like a pendulum, when it goes on the right side, it doesn't come and stop in the center. It goes to the left because of that inertia. So similar thing will happen and we may go down below 20. And below 20, 15 to 20 is a value level where anyone and everyone can enter broader index. We are moving towards that. We are moving towards closer, which means the margin of safety is much higher right now than what it was about a year back or 6 months back. The second is price to book of the Nifty 50 stocks. It is at 4.03 right now. It was a high of 4.26 last year and low of 2.17 on March. Okay. And 10-year mean also I have, it was price to book was around 2 and high was 4. So right now, and anytime when the price to book is fairly stable, it doesn't vary like PE very frequently. So if it is around 3, it is certainly underpriced. It is still not closer to 3. So if you look at this parameter, it is giving a confusing signal. And dividend yield when it is 2, like it was in March 2020. When the dividend yield is high, the prices are low. It indirectly says that the share prices are low. Nifty 50 stocks were giving 2% yield, which was very good yield, but the prices were very low. Which was at 1.11 last year, which meant the prices were very high. Right now it is at 1.4. Anything above 1.5, 1.6 would be a good level. I would look at investing in index. So these are the 3 parameters. Broadly, I look at there are various other parameters which you can look at. But to conclude, I would say that markets are certainly not overvalued. Markets are reasonably priced or moving towards the lower level. Investing at current levels, you have a much higher margin of safety. But only thing is, market will always behave funnily and it will come down. It never settles on at fair value. It will come down. It might. So go for an SIP for the next 12 months. When I say SIP, normally we tell a different type of SIP. There is aggressive SIP and there is a moderate SIP. Now this is the time to go for aggressive SIP. If I'm planning to invest X amount over next 5 years, now I'll try to invest in the next 2 years itself. Because I feel that next 16, 18 months is going to throw excellent opportunities for us to invest in Indian markets, as well as US markets, in a very big way. And we should not miss this opportunity because we have made all these companies as rich companies. And if we are not part of it, when all those companies are offered at such low price, I think God only can save us. I think we should not miss this opportunity. We should make use of this. Thank you very much. Thank you, CJ.
Thank you very much, Nagappan sir, for sparing your valuable time and enlighten us on the importance of investing in stock and how to manage our funds in volatile market and in volatile times. It's time now to honor our speaker. May I now request CA Veena Gayatri to come forward and present a memento to Nagappan sir. With that, we have come to the conclusion of today's program. Thank you one and all for your august presence. Let us all rise for national anthem.
जनगणमन अधिनायक जय हे भारत भाग्य विधाता पंजाब सिंध गुजरात मराठा द्राविड़ उत्कल बंगा विंध्य हिमाचल यमुना गंगा उच्चल जलधि तरंगा तव शुभ नामे जागे तव शुभ आशीष मांगे गाहे तव जय गा